Eliopoulos, you're on.
Thank you, Mr. Chair. I'll turn it over. We're starting the section on examples of waterfall accounting, and I'm going to turn it over to Scott Jacobson, who's an investment director in the CalPERS Private Equity Group.
Thanks, Ted. As Ted mentioned, I'm Scott Jacobson, investment director in private equity. We're going to walk through this section to really dig into the nuts and bolts of a lot of the terms that you've heard about earlier in the day. Specifically, we're going to look at how those terms are accounted for and what the economic impact is to a limited partner like CalPERS. I'm joined here by David Larson, who's a managing director at Duff & Phelps and a member of the portfolio evaluation area. David has over 30 years of experience in accounting and transaction services. Additionally, he serves as vice chair of the International Private Equity and Venture Capital Valuations Board. And in the past, he's been a special advisor to the Institutional Limited Partners Association. David's going to walk through generically how these fees and expenses are accounted for, and then I'm going to walk through 6 specific examples of funds from our portfolio before we talk about transparency and answer any questions that you might have. So with that, I'll turn it over to David.
Thank you, Scott. Pleased to be here. Thank you to the committee for inviting me. We've talked about a number of different items already today, so I'll go fairly rapidly, but try to identify some of the key points and do that. This type of presentation is very difficult from the perspective of, as we've just heard, waterfalls are very complex, agreements are very complex. The moment you try to simplify them, it actually makes it in some ways more complex. So we've created some somewhat simple examples that are definitely subject to discussion, but they were designed to provide some additional feedback and just insight into how things work. Just a few observations in advance of going too deep, and those are, what we're trying to do now is just to talk about the actual cash flows. And the cash flows are the cash flows. Your IRRs are your IRRs. There is not a lot of judgment in some of these pieces. There's judgment in how you interpret agreements and how that then results in the cash flows to you. And so it's really focused on what are those judgment areas, but once you have the cash flows, they are what they are. This is a very busy slide, but the point here is to talk through some of the different buckets of costs or buckets of cash flows that an LP and GP relationship enter into and how that works. And again, we've already heard from the legal side, so I won't spend a lot of time, but also highlight where there's areas of, let's say, judgment, or areas where you could look to say, areas where you could think about it to say where could there be, I'll use the term leakage, where a limited partner may be disadvantaged along the way. So the money that goes into that limited partner, general partner relationship into the fund, one of the first areas is for fund expenses. We've already mentioned that audit fees, legal fees, those type of fees are involved or are paid for by the fund, all of the limited partners together. That is an area that I think that the ILPA templates may provide some additional transparency, but that's probably the area that is more subject to judgment and more subject to possible discrepancy than any other, is to make sure that those fees and expenses are the place where you've agreed to them. I think as Marte mentioned, there can be a lot of different carve-outs or descriptions in an agreement on what is a fund expense and what is not a fund expense. An audit fee for the fund is usually a clear fund expense. An advisory fee to somebody providing consulting services to a portfolio company may not be a fund expense. It may be just a pure portfolio company expense, may not be an offset expense, as we come to in a moment. Organizational expenses are the type of expenses when you set up a fund. And again, those are shared. General partner types expenses are expenses that are borne purely by the general partner. Fundraising expenses usually come into that bucket. Management fees we've already talked about. Those theoretically pay for the base expenses of a fund, including salaries, rent, and the like. We'll get more into fee waivers. We touched on that on the legal side. Then you've got the key cash flow is the actual cash invested for an investment. And then you have things such as portfolio fee offsets, where a portfolio company may be paying a fee to the general partner. That general partner may be sharing that with the limited partner. So there's a number of different areas where you've got cash going backwards and forwards. The key thing is, does it follow the agreement? Is it transparent? Do you understand what those are and how they function in the context of the deal that you signed up for? As we talk about cash coming back to the limited partner, really just think about it, again, from the types of buckets and the types of cash flows, and we'll go through these again in a moment. What is the return of capital? So you get your capital back. You put capital in, and that's the capital back. Again, usually it's going to be the limited partners get 99, 98%. The general partners usually 1 or 2%. And that initial return on any investment, based on that percentage, the general partner takes their percentage of the proceeds, and then the remainder flows through the waterfall. Fees and expenses are returned. The preferred return or hurdle, and we'll show how that works. I think preferred return in some ways is a misnomer. It's really more of a priority of cash flows, so that the limited partner receives, let's say, their 8% return first, but then the general partner catches up. So it's not that they get you automatically get your 8%, but you get 8% before the general partner gets any additional incentive fees. Then and that's where the catch-up comes in, and then you have the profit allocation at the end. This is just an example, and I think we'll actually skip over this very quickly because Scott has the further examples later on. But it just highlights how you look at the different pieces of an agreement. The money flows through the waterfall, limited partner, general partner. You have a hurdle, you have the catch-up, and then you get to the amount of the total distribution after fees and expenses and the return of all the costs. But we'll dive into that a little bit more as we go along. So first want to touch quickly on that, as we mentioned, the hurdle or preferred return and catch-up. It's not, again, designed that you are automatically getting that. It's just really a timing of the allocation of the of profits and the timing of cash flows. And this example is maybe an easier way to identify. And there's two different terms that we're illustrating here. One is that the GP gets 100% catch-up, and the second is that the GP catch-up is 80-20. So in this example, again, it's been overly simplified. Take out the management fees just for ease of discussion, and it's been simplified to 1 year just for ease of how it works. So we received 150 of proceeds. Of that, the return of capital is 100. So the preferred return, or 8%, means that the LP gets the first $8 of the additional profits. So now there's $42 to be allocated. And in that first scenario, the GP catches up. So they get the next $2 that are flowing through the waterfall. At the end of the day, the LP gets 140, the GP gets the 10 of the 150 that came out. In an 80-20 scenario, the same $8 comes out first for the LP. There's 42 left over. The next $2.7 goes 0.5 to the LP, 2.2 to the GP. That's the 80-20 catch-up. But at the end of the day, you end up with the same 140, 10, 150 total split. So you say, well, why does it matter? Why do I care about that 80-20? We care about the 80-20 when things are not when the fund does not perform as well. So this is the same example. but rather than 150 of proceeds, we only have 110 of proceeds. So again, in the 100% catch-up, the LP gets their 8, the GP gets their 2. LP's got 108 in total. The GP caught up because of the 100% catch-up, and that's where of the 110 that was allocable, the LP's got 108, GP got 2. In an 80-20 scenario, because the GP doesn't catch up as quickly, in that case, the LP got slightly more, 108.4. The GP only got 1.6. So the 80-20 term is a more favorable term to the limited partners, but the hurdle is just a catch-up mechanism or just a timing of cash flows mechanism. As has been discussed, as now we talk into the differences between management fee and profit interest and how that impacts the waterfall and the cash flows. I think that there's been some discussion along the way as where can one negotiate? Can one negotiate the management fee down? Would one be willing to pay more carried interest? And so that we'll just take an example to try to look at that and flow things through. Now as you look at the assumptions, again, these are simplified assumptions for illustrative purposes. Say, well, we've picked a 95-5% LP-GP split, but you just said that generally that's 1% to 2% for the GP. Why did we pick 95-5? It's just to make the numbers rounder, so some of us could do the math a little bit easier, and so that the numbers stick out a little bit, because if at the 1% level, they kind of get lost in the rounding a little. So that's why we chose that. It doesn't have, from an illustrative purposes, I think the outcome would be the same. So the first, there's 3 different scenarios presented here, and some of the math that supports these calculations are included in the appendix if we were to want to go there. But the 3 different scenarios are a 2% management fee, an 80-20 profit interest allocation. As you can see, as you flow that through the waterfall, and in this case, again, the commitment, the fund size we said was 200. Based on that 95-5% split, based on the management fee, we assumed that I think the management fees were 2% of the commitment, and we just took that out for 5 years. Again, you could take it out for 10, but just for illustrative purposes, we chose to do 5 just to make, again, the math a little bit easier, and the discussion would turn out the same. The IRRs may be different if we went to a little bit longer. So first scenario is the LP invests 171, the GP invests 9. And we're going to use these numbers throughout the remaining examples just to try to make it a little bit easier. The total management fees and fund expenses were 20. So the ultimate cash invested by the LP was 191. We said that we got a 2.2x return. So the cash returned is a total of 396, of which 339 comes to the LP, and the total gain is 148.2 for the LPs, a 12.65% IRR. If we use the exact same assumptions but move to an 85-15% carried interest split, the LP moves up to 157.4, and the IRR is improved because the cash flows are improved. Again, using that same assumptions in the third scenario, moving back to the 80-20 split, but reducing the management fee, the actual cash received is 155.8, so less than the previous example. The IRR is slightly higher because we're putting less money to work over the 5-year period because the management fee is less. And so that just demonstrates that around that 2x inflection point, plus or minus, depending on the timing of cash flows. One could be better off if you were investing in a poorly returning firm or fund by getting a lower management fee. But you might, if you could negotiate a higher or a better carried interest split in a higher performing fund, obviously that would be more advantageous. There's been a lot of discussion on fee waivers. fee waivers are not applicable to all managers. We're not here to debate at this point the validity or the legality of using fee waivers from a tax perspective, but just to look at the impact on the cash flows. I think, and I agree with Marte, as he said earlier, it's really neutral from a cash flow perspective in many cases to a limited partner, and we'll show that, though it does could have a drag on IRR. And the fee waiver side is, there are some tax advantages for certain classes of limited partners. And just to put that, it's probably a very small piece of the world. CalPERS is not in that world, but there are some pluses and minuses. So it's not just a GP item, but could be also a limited partner advantage also. So again, we're looking at in this case I think four different scenarios. And looking at the fee waiver. So the first set of figures is, again, the analysis that we had just gone through. So we commit, the limited partner invests 171, they have 20 of fees, they get 191 back. 191 is their total investment. There's 396 returned, exactly as we had before. So that's the base case. No fee waiver. Once we have a fee waiver equal to the GP commitment, and this is I think to illustrate in numbers, the cash flows for the LP are exactly the same. The LP still puts in $191. That's because the management fee is reduced by 9. It's because the general partner commitment is effectively borne by the limited partner. So the general partner didn't put in the 9 that they did in the base case, but they also didn't receive the fees of the 9. And so as you can see, the return is exactly the same. There's a little bit of a drag on the IRR because the LP is effectively pre-funding the GP's commitment. So they're paying cash more quickly than they would if they were just paying the management fee. So there's no impact on the actual ultimate cash received. There's a slight impact on the IRR. Same thing on the last two columns is if there was a fee waiver, but the return is small, so that there is not much carried interest, there's not much profit interest. Again, the cash flows are identical. The IRR is slightly worse in the fee waiver scenario as opposed to the non-fee waiver scenario. So as you look at that, you say, all right, from a pro perspective, why would we do a fee waiver? If we were an LP, it could incentivize the manager because of the tax nature of the fee waiver situation. It gets to be very, very complicated, but it's not just because you say I'm doing a fee waiver that the general partner gets a tax advantage. They have to have profits along the way from the fund, and so if they don't have the profits, then they actually could be disadvantaged. So there is some that would argue that fee waivers further incentivize the general partner to do a very good job. It is complicated. It could, because of that same tax issues, it could encourage a general partner to time exits. And as mentioned, it does have a slight drag on the IRR from the LP perspective. Fee offsets, to distinguish from fee waivers, are the types of fees that Marte went through earlier, where Marte and Paul, where you were identifying items that effectively reduce the management fee. Those could be a monitoring fee. Sometimes they're transaction fees. Sometimes if the general partner is providing, let's say, consulting services to a portfolio company, those fees would not necessarily be offset. So again, a strict reading of the limited partner agreement identifies what would be offset, what would not be offset. Another question that often comes up with fee offsets is, would the what happens if the fees exceed the management fee? So if in other words, does that still get shared with the limited partner to the extent that there is some sharing, or does that all go to the general partner's pocket? So the key question there is there sufficient transparency? And also an ultimate question that we'll come back to in a moment is, do those fees provide a benefit to the portfolio company, and do they impact at all the value that the limited partner ultimately receives? So again, we've got several different scenarios. And in looking at, so we still have our base case scenario, no fee offset. The second scenario is a 50% fee offset. So these are fees coming from the portfolio company to the general partner, and we're making the assumption that those offset the limited partner's management fee by 50%. As you can see, the actual because of that money coming from that portfolio company, the actual cash received by the limited partner is greater, the IRR is greater. So it's a benefit to the LP. The key question there is are the fees that are coming from the portfolio company, the assumption embedded in these numbers is that it did not impact the value upon exit of the portfolio company. And one can ask, well, how can that be? Well, it depends on, and that can be a very judgmental question. If the fees are at a level that it does not impact the growth of the portfolio company, when that portfolio company is sold, it is usually sold based on the expected performance, sustainable performance. So any types of expenses that are non-recurring, such as these type of monitoring fees, are usually excluded by the buyer. And so theoretically, they don't impact the value upon exit. So it's not harming the LP upon exit as long as the cash is being shared with the LP as it's coming out and doesn't impact the growth prospects of that portfolio company. Net, it is a benefit to the LP. If there's 100% fee offset, as can be seen, again, the cash flows to the LP go up to the 163. The IRR is higher. The downside is and the last scenario is the acceleration payment. And let's say in this case that acceleration payment was 30. If that acceleration is not shared with the LP, then you have both a dip in the cash flows and you have a dip in the IRR. So it's really a question of that alignment of interest, and then if the fees are 100% offset, and if the fees are greater than the management fee, and if they're appropriately shared, that gets to the pros and cons. As long as they're appropriately shared, it may be an advantage to the limited partner. It's not an advantage to the limited partner if there's not transparency, you don't know that you've captured them all, or if you don't know that, or if there is an impact on the exit value. This acceleration payment, another way to think about that is when you exit a company, usually any excess cash is shared as part of the proceeds with the GP LP. So in this case, that 30, where the acceleration came out and went just to the GP, again, that if it had been left in the company, then it would have been shared the 80-20 between the LP and GP. So that again, that's why a non-sharing situation is not a good answer for an LP. So I think you take all that, went through quickly, and we'll, after Scott goes through a few more examples, we'll respond to questions. But I think that some of the key pieces are that my takeaways are management fees, fee offsets, allocation of profit interest are all subject to negotiation. There's a good deal of negotiation went into it, even though the pendulum swings at different times as to whether the LP has an ability to push on those terms. The fee waivers don't necessarily, we've heard a lot of bad press about them, but they don't necessarily impact from a factual basis the cash flows. They do impact IRR. Fee offsets actually could be beneficial to an LP depending on the situation. The key piece is that we need to have appropriate alignment of interest and transparency.
Great, thanks, David. So David's gone through theoretical examples. What I'd like to do is give you 6 real-world examples from the CalPERS portfolio. What we tried to do with these examples is capture a full breadth of funds, some that have been fully exited, some that are at the end of their investment period, some that are deal-by-deal waterfall, some that are European waterfall, some that have 100% offset, some that have less than 100% offset. I think the point is, there are almost countless iterations of how these terms can play out within our portfolio. What we wanted to do is choose some that would be representative. But as you've heard before, one of the reasons that there are so many permutations of different terms is that different investors value different terms differently. We at CalPERS have been very focused on reducing management fees, reducing carry, and trying to have management fees paid on invested capital as opposed to committed capital. We think that those are the most impactful from an economic perspective, and that's what we've been focused on. The problem is other LPs might feel differently. They might have a different view on paying less management fee and trading that off for higher carry to the GP, or they may care less about a preferred return. So what we wanted to do was explain, how we think about it at CalPERS and some of the funds that we have within our portfolio, and then just walk you through how the waterfall plays itself out. So you can see on this slide, these are the same funds. I won't take you through every single fund. I think what I'll do is I'll take you through Fund B, because that's a fund that has been completely exited. And you can see how the various fees and expenses have affected our return. So I should have mentioned what we did with all of these funds is we rebased them to a $100 million commitment level, such that if we put the actual commitment level in there, people might be able to get on the website and see what the funds are, and we wanted to maintain the confidentiality. So all of these are rebased to a $100 million commitment level. So you can see in Fund B, the total capital called was $94.2 million for investment, another $5.7 million for fees and expenses. At the end of the fund returned $217 million. We received $94 million back as our return of capital. We received our $5.7 million in fees and expenses, and then the carried interest to the GP was $22.2 million. So the net gain to CalPERS was almost $95 million on that fund. The second section shows how the offsets affected our investment. So our gross management fees were just less than $8 million, but $3.6 million of that was offset through our sharing of fees with the general partner. That left net management fees of $4.3 million, and then partnership expenses, which were separate, of $1.3 million. So total net fees and expenses of $5.7 million. Now, the other point I wanted to make on this slide is if you look at the bottom red boxed area, you'll see the gross to net spread. The gross IRR at the top line, the net IRR to us, and the spread ranges from 2 to 8% in these examples. If we were to look throughout the portfolio, we could find some examples that are probably closer to 15%, and we could find some examples that are probably closer to 1%. It all depends on the terms of the fund and the timing of the cash flows. I think the academic literature, and I think Eric referenced this earlier, has it about a 700 basis point gross to net spread. It's important to note, as I do in the footnote here, that this does not include, as the academic literature does, another 1% or 100 basis points for portfolio company expenses that aren't subject to offset that could impact the value that the limited partner receives. Moving to the next slide, what we wanted to do here was show the actual annual cash flows for these various funds. On the first page, you see here Fund B. This is deal-by-deal waterfall. The bar charts are the annual cash flows, below the line, negative, above the line, cash coming back to us. The red line is the cumulative cash flow of the fund, or what we call the J curve. You can see on a deal-by-deal waterfall that the profit participation for the general partner happens earlier in the life of the fund. Because it's not required to return all the capital to the limited partner, they're able to share in the carry earlier. This means that the J curve is deeper, and we don't reach cash flow break even until later in the fund life. This also leads itself to a potential clawback situation because the general partner can be taking carry before all of the capital is returned to the limited partners. By contrast, you see in Fund C a European waterfall where we get our cash back much earlier because the general partner is required to return all fees and expenses to us before it can participate in the carry. This means we get our cash back earlier, as I said, but it also mitigates a potential clawback issue. It can happen in a European waterfall, but it's much less prevalent than it is on a deal-by-deal waterfall. One of the criticisms of a European waterfall, because the general partner needs to return all the capital to us before they participate in the carry, there might be some gaming in terms of the timing of exit. And they may exit certain investments earlier to get to that point where they can participate in the carry. But again, we don't see that in our portfolio, and we prefer European waterfalls to deal by deal. The next slide shows the effects of a management fee waiver. As David pointed out earlier, this really has no impact on the actual cash flows that we experience. It could have an impact on the IRR of those cash flows. You know, this is a controversial term in a lot of cases. I think we would prefer to see general partners write checks and actually put money out of their bank account into the same companies that we're investing in, because it's an emotive issue. You know, when you have something tangible that you're writing a check for and putting into the company, I think it's a little bit on the margin, a little bit more impactful than some future management fee that you're waiving. On the other hand, because there's no impact to our cash flows, we can often trade this term for other terms that might be more important to CalPERS. So it's a fine line between those two issues. Next slide shows the management fee offset. Again, this is Fund B. You can see in this example that 45% of our total management fees were offset, meaning that we didn't have to pay 45% of our contracted management fees. The other thing that's unique about this example is that the fees, if there's a surplus of fees, they're returned to the limited partners. So you can see in year 14, there's cash coming back to the limited partners because that's when the fund was fully exited. So what exactly are these various fees and offsets, and what's the magnitude? So this again is Fund B, which has transaction fees, monitoring fees, advisory fees, breakup fees, and directors' fees. And then we've also highlighted a couple of other fees that this fund did not have. So transaction fees are fees received by the general partner for basically setting up a transaction. It's a lot like an investment banking fee, if you can think of it that way. Monitoring fees are kind of like ongoing consulting fees for monitoring their investment, giving general advice, helping the company with certain issues. Directors' fees are fees that the general partner takes for serving on the board of directors. These can be cash or non-cash fees. Commitment fees we don't see very often, but they can exist. These are similar to what a bank might charge in a revolving credit facility, where the general partner may have committed to a certain amount of capital, maybe only invested half of that capital, but is taking a fee on the other half of the capital until the company takes it down. Breakup and topping fees, these are fees that are typically put into agreements if a general partner agrees to invest in a company and then another investor comes in and pays a higher price, the general partner will typically get a breakup fee or a topping fee. And then the last two fees, financial advisory fees and capital markets fees, are similar to transaction fees. These are what I would characterize as investment banking fees. Capital markets fees, there's typically a broker-dealer subsidiary for the general partner, and they're underwriting debt or equity securities for the portfolio companies. You can see in the schedule that transaction fees and monitoring fees are the vast majority of the fees that the general partner collected in this case. And those were 100% offset to the limited partners. So you've heard a lot earlier in the day about ILPA and the proposed capital account details. We've been working, CalPERS has been working with ILPA for over a year on this transparency initiative. We have been working alongside other limited partners. As Ted mentioned earlier, this will go live in January. We're currently in the comment period where general partners are giving their input as to how excited they would be to comply with this level of detail. But we expect that there will be enough momentum behind this from CalPERS and other large LPs that general partners will abide by these proposals and start giving us this level of disclosure. And what this level of disclosure entails, this is probably too difficult to read, but you can think of it as this in this way. What we want to know as a limited partner is every single cash flow between the general partner, the fund, and the portfolio companies. Whether or not it's offset, we want to know about it. So that includes things like travel expenses that the general partner might get reimbursed from portfolio companies. It includes things like fees for group purchasing agencies that the general partner might have an economic interest in. What we're doing at CalPERS and alongside ILPA is we're trying to get as much disclosure into this proposal as possible, and we're hoping that the general partner community will adopt it. If we don't get that, we'll continue to do what we've been doing at CalPERS, which is putting in our legal agreements, typically the side letter, the level of disclosure that we expect from our general partners, and we'll continue to hold them to that. With that, we can open it up for questions.
JJ?
The first question actually goes back to 66, and I wasn't here. I was talking to the auditor at the time, so you may have answered the question, and if so, I apologize. But there's $17 million at the bottom that, and I just didn't understand where the 17 million came from.
These cash flows are an example, a real example that has been resized. That 17 million in part, and this highlights the complexity, I think primarily results from recycling. So in the early stages of a fund, you commit capital, they may have a quick return, and that gets recycled, so it gets captured there, and that's primarily recycling.
Okay. And you talk about the fee waivers, and you deliberately did not get into the whole problem with the IRS and them basically saying it's a fraud. But earlier, the two CIOs had said that they were concerned that if that got outlawed, it would impact are fees? Do you have, can you share any?
What I heard is if the tax on carried interest changed, that could impact things. So I'm not sure that it's as much the fee waiver question, and whether or not fee waivers, whether they adjust legislation to prevent fee waivers. But the other question is, should profit interest be taxed at a capital gain rate or an ordinary income rate? That, I think, is what they were speaking to. We can ask them.
And now that you pointed out, you're right. On 86, which was the Fund B waterfall, the red line is basically the J curve that we consistently hear about. But since they are paying out part of the carried interest, the J curve really reflects the cash flow, not necessarily the returns of the fund. So you can have positive returns even though you're still going down the J curve.
That's correct. The J curve is really just the cumulative cash flow of the fund.
Okay, so when we're told, well, you really shouldn't pay much attention to these early returns because that's the J curve, they're really two separate issues. And on slide 90, breakup and topping fees.
Yeah.
In the public market, those were the stuffs that they would normally call broken deal fees, even though private equity uses a whole different meaning of the term broken deal fees.
Yeah, and broken deal fees in the context of private equity typically mean expenses that were incurred and the deal never got consummated. What we're talking about here are, fees where the general partner actually had a contract to invest or buy a company. Some other bidder came along. As a provision of that original contract, there is a breakup fee so that if the company wants to go with the second investor, they have to pay the first investor to do that.
Okay, and that's what the public market would call a broken deal fee, as opposed to private equity. So, okay, thank you.
Okay, Priya?
I have another.
Thank you. I think, Scott, you talked a little bit about the behavioral implications of the management fee waiver and why we would consider, even if on a cash flow basis it's net for us, why we might not like it. But could you talk a little bit about, one of the things David talked about was that actually it's better for us as a general rule to reduce the carry versus reducing the management fee. But it seems to me that there are some behavioral implications there as well, that if you can get rich off the management fee, then maybe you don't work as hard as you might if you're only focused on carry. Could you talk a little bit about how you guys are thinking about that?
Sure. No, it's a very good point. I think I failed to mention, one of the reasons we also don't like management fee waivers is that, if management fees are supposed to be just covering expenses and they're able to waive these fees in lieu of their GP contribution, it implies that the fees are too rich. So that's something that we definitely take a look at. But if you look at Fund A, which we have in this example, this is one where a lot of the GP commit is contributed through a fee waiver, but it's also a very high GP commit at 8%. We typically see GP commits in the kind of 1% to 4% range. So this gets back to the point that it's not always clear cut. If the general partner is willing to waive a significant portion of their management fee, such that it increases their participation in the fund to higher than normal levels, is that a good thing or a bad thing? And so it's hard to kind of isolate one without looking at the entirety of the situation.
Okay, Bill?
Thank you. Just a quick technical question on page 90 under fee offsets directors' fees. I understand in a public company setting non-cash directors' fees, but what would be an example of that, how it would apply in private equity?
It's similar. So it'd be equity in the private company that the individual, or in this case the general partner, would take, and then when the company goes public or gets sold, it's incremental compensation to that individual or that entity.
So it changes the ownership structure of the portfolio company?
It's similar to what you would see in a public company, where if you have a director, they might get stock options or some sort of stock grant, with the idea that that aligns them with the performance of the company. Similar things happen with private companies. It's just private stock. It's typically not a significant percentage of the company.
And it's an offset item anyway?
It can be an offset item. It depends.
Do you see limits in it?
Pardon me?
Do you see limits with it?
Limits in terms of?
Limits in terms of how much of that can be granted.
Yeah, I don't know specifically. I would hate to quote a number, but you typically don't see more than a few points going to, percentage points going to the board of directors.
I'd say it's de minimis.
Talking to your mic.
I would say it would be de minimis compared to what management has. So often in a private equity deal, management has options. If it performs well, effectively the limited partner, general partner get diluted. Management gets more of the company. That board piece is usually de minimis compared to that.
Thank you.
Okay, JJ?
Yeah, you said a number of times that the cash flow was the same, but the IRR was different. If the cash flow is the same, how's the IRR different? I mean,
Because the timing of the cash flows are different.
so the cash.
So
The
it's
total
pure,
amount of the cash flow is the same.
Exactly.
The cash flows themselves are not the same.
the total amount is same. The individual cash flows happen on different times depending on whether it's fee waiver, whether it's non-fee waiver. And that either accelerates or decelerates the cash, the aggregate cash, which is exactly the same, to the limited partner. And that changes the IRR.
Thank you.
Okay, I think that concludes the questions on that section, that panel, and thank you very much for your presentation. Ted?
All right. In conclusion, here we come to the last section, and this I wanted to cover. Well, how does all this information that we've just received either fit into or conflict? Hopefully, not conflict with the vision that we have for the next 5 years for the investment office and the investment portfolio. And I think as a reminder for the committee, you've seen in many different presentations from myself and Wiley the vision for the next 20 years, and how does private equity fit into that vision? And one, certainly it remains as an important investment exposure for CalPERS. And one of the hallmarks that I want to spend a little bit more time on is this notion of concentrating with fewer external managers. That's really a key component to the Vision 2020 across the whole plan. And certainly for private equity, it is one of the strategic choices that we've made going forward over this next era for private equity, is to concentrate in many fewer external managers than we have in the past. We think that will benefit us in terms of cost structures that we're able to negotiate, even in the face of the supply and demand dynamics of this marketplace. It will allow us to demand and receive better transparency and disclosure. And then lastly, something we haven't talked about today, it will also allow us to better, I think, monitor the investments that we have in our portfolio. And this slide gives you a sense of the at the total fund level. You can see we have currently on the far left, or you look back to 2005, I'll start out with on the left, over 400 external managers at that time. And you can see that number reducing to a little over 200, 212 currently. And our goal in 2020 is to have 100 external managers across the total fund by 2020. And you contrast that with the red line, which is in 2005, CalPERS had about 114 investment professionals managing those, overseeing the whole portfolio, including the number of external managers. And you get to the red line at 2020, and we're showing roughly this, we're showing exactly the same number of investment professionals that we have today. It reorients the equation of the ability and number of investment professionals here in-house vis-a-vis the array of external managers that we have within the portfolio. And you then take that to the private equity portfolio, and it's a similar story, similar lines, but also I think even more dramatic. You can see in 05, 275 private equity external managers in 05, and that's that reflects a portfolio construction at that time, which is approaching that notion of having an index of the whole market. You have so many different managers, and there's such a larger percentage of the overall market, and you can see that currently we have less than half of that, 102 private equity external managers in our portfolio today. And our objective by July 1st of 2020 is to have 30 private equity external managers. So certainly this strategy that we've chosen as a team is to place our bet on a much more concentrated portfolio in private equity with the hopes of identifying the outperforming managers and hoping that their persistence in that outperformance will continue into the future. But we don't believe we could replicate the experience we had over the past 20 years in having a overly diversified and index fund that would produce the type of returns that we hope for going forward. So that is an investment choice that we've made quite deliberately. With the number of investment professionals in our private equity group, we're able to have nearly a 1-to-1 ratio between the investment professional within our CalPERS investment professional within our private equity group and the private equity manager that they're negotiating with and monitoring, and we think that's very important for all the reasons that we discussed today. One of the things that we're encouraged about over the course of the last 3 years under Rial's very dedicated leadership and the work of the whole private equity team, and as Scott alluded to, is a laser focus even in the face of some of these challenges that we've discussed, particularly the supply and demand challenges of the marketplace, is to focus on negotiating at the margin better terms and conditions, and certainly at the margin focusing on our management fees paid and carried interest percentages agreed to in the years 2012, 2013, and 2014 are significant and result in benefits to the CalPERS and our beneficiaries for many years to come. We haven't in years past disclosed this sort of high-level sort of information on our negotiated fee rates, but we think it's important, one, given the questions that have been posed to us about the performance of our private equity team and its professionals and the effectiveness of our team. And I believe, and we believe, that these results are quite significant and put us in a good position going forward with our private equity portfolio. But they're not everything. And I think we've got a full dose of that today within the with this discussion. There are many, many, many other terms and conditions that we agreed to which are beneficial to the general partner and not beneficial to the LP, and we agreed to those terms and conditions knowingly and assumed the risks that those terms and conditions pose to CalPERS. I think we've talked a lot about the ILPA. I shamelessly borrowed this from Keith Ambachshire. This was his, one of his slides to the National Treasurers Association over the course of the last few months. And we do. I think this is a window of opportunity for institutional investors to make a very marked change in not only the level of disclosure in the private equity industry, but the standardization of that disclosure, to have the same disclosure protocol across the industry will benefit LPs, not just in the access to the information, but having the same information for investors to compare returns across general partners. And I'm hopeful that this will get over the finish line in January. Last, we've talked some today, and I just want to re-emphasize the point that our general counsel made in response to an earlier question. We do believe that the ILPA disclosure initiative is vital to get across the finish line in January, because it provides a voluntary and very near-term benefit that I just described. Over the longer term, it may be necessary and it may be beneficial for regulatory initiatives, especially if these voluntary efforts prove to be ineffective or not adopted either by the general partner community or the LP community. In addition, it allows for an interim step to be taken now where there are things that we might learn as a result of the increased disclosure that we receive. And I think that we would be well served to take a bit of a interim step over the course of the next year or two to see what we learn from these disclosures before regulation is begun. With that, I think we've had a long day today in this workshop, and Mr. Chair, I'll turn it back to you.
Oh, Mr. Barkin.
Thank you. Thanks, Ted. And sort of on that note, as most of you know, the Treasurer wrote a letter last month to the board, to staff, kind of outlining his plan to pursue legislation that requires private equity partner or general partner fee disclosure over the next year. And the board hasn't had a chance to react, to discuss that yet. And I don't expect that today. It's been a long day. But one of the things that the Treasurer wants to make sure is that whatever language for disclosure is in the legislation is consistent with the standardization you're talking about. So whether the board takes a position or not, I think it'll be important for staff to have a role and have some input. And so I'd like to start having my office, if you could sort of identify the team that we should be reaching out to as we go through that process. I'd appreciate that.
Yeah, Mr. Barkin, I did receive the letter from the Treasurer, and we did indicate, I did respond to him, by the way, that we would be, after this meeting, talking to him about the issues he raised. But I thought it was appropriate to have this meeting first before we talk about going forward with any legislation.
Yeah, and thank you. And thanks to staff for, I thought this meeting was very informative. I learned a lot. So.
Yeah. Okay.
Thank you.
Okay, thank you. Now, we do have two requests to speak, and I just want to indicate that anyone else that would like to speak, you could sign up at the table in the back. And normally our practice is to allow 3 minutes to speak, but I think we have enough time, then we're going to extend that to 5 minutes today if anyone wants to speak, because I know it's a lot of material, and I don't know what part you may have an interest in speaking on, but we are going to extend it to 5 minutes today. So if anyone else would like to speak other than the two I have, you could sign up over there. So I'm going to call. Do you have a mic over there? Okay. So Mr. Don Ochola? Yes. Oh, okay. Okay. Yes. Oh, come up here so the committee can see you as you make your comments.
Hello? Well, I'd like to say the following. In looking through the presentation, I'm struck that there is no mention in any of the slides that 4 of your largest PE managers, who collectively manage close to 40% of CalPERS PE commitments, are publicly traded companies. The fact that Blackstone, KKR, Apollo, and Carlyle are publicly traded bring into question CalPERS' assertions that it can successfully align its interests with these PE managers. Despite CalPERS believes that these executives and founders are motivated by their pursuit of carried interest in the funds, the reality is much different. By examining SEC 10K annual reports, it's easy to see that increasing dividends, payouts, and stock appreciation and not carried interest are the overwhelmingly predominant income source for these private equity executives. For example, looking at Steven Schwartzman's compensation, he's the CEO of Blackstone. From 2012 to 2014, we see that in that period he made approximately $1.1 billion in dividend income. I'll take a second to let that sink in for a bit. From that same period, he only made approximately 116 million in carried interest. In other words, carried interest represented less than 10% of the total cash income that Mr. Schwartzman received from 2012 to 2014. For Mr. Kravis and Mr. Roberts, co-CEOs of KKR, carried interest represented approximately 36% of their cash income during that same period. Their non-carried interest income was about 238 million, and approximately 780 million for Mr. Black of Apollo. Again, these amounts do not include carried interest that they earned over and above these figures, only that also these numbers do not include earnings from their investments in their own funds. Putting aside the astronomical sums of money that these CEOs have collected over a 3-year period, primarily at the expense of public pension funds like CalPERS, the important point is that most of the income of these publicly traded companies is generated from fees you pay regardless of whether or not the funds you invest in are profitable, including management fees and portfolio company fees. It's important for you to recognize that Wall Street analysts who cover the stock of these PE firms praise them for maximizing this recurring fee income and give them relatively no credit for earning profits from carried interest, because such profits are unpredictable and uneven. The perspective of these analysts has a large impact on the stock price of these publicly traded private equity firms. So the fact that the analysts disfavor carried interest as a source of profit has a huge impact on how these firms structure their business. Again, it's a little disappointing that your outside experts fail to point out this fundamental reality, and I'm glad to have the opportunity to share this with you. In my final comment, I hope will bring into question the long-standing belief among pension fund investors that private equity is an enormously successful investment strategy whose returns are so spectacular that pension funds need to acquiesce into private equity managers' demands, even to the extent of compromising their own principles, simply to avoid being excluded from hot funds. Over the past few months, I spent a considerable amount of time looking through countless public pension annual reports looking at private equity returns. What I have discovered is that in the vast majority of cases, pension funds either underperformed their 10-year benchmark or had beaten their benchmark by 1% to 2%. In fact, both CalSTRS and the Public Employees Retirement System of Idaho are examples of pension funds who, like CalPERS, have not beaten their benchmark. So I turn to your consultants and ask, if the vast majority of pension funds are either not beating the benchmark or are barely beating it, where exactly are the pension funds who are generating spectacular returns from investing in private equity? Thank you.
Thank you. The next person to speak is David Soares.
Thank you.
Okay.
Thank you. I'm just here as a member. I've been a member for 30 years. I'm here on my day off. I took a day off from work at my day job, which is as a lawyer and prosecutor, and I actually currently focus on fraud cases. I used to be an executive board member for 12 years of my bargaining unit and used to come to meetings here in Sacramento at CalPERS. And I was kind of surprised because I've been following in the press and some of the marginal press like the New York Times and the Financial Times of London and Forbes, some of the controversy here, and I wanted to learn about it at first hand. And I was kind of surprised when I came here. We had a presentation that I think was on some very important topics, and I applaud that all those topics were part of the discussion. But public comment was prevented, even though they were, at least on the agenda that I have and saw online, each agenda items. And I'm really concerned that under Government Code 11125.7a, we should have had public comment, and I would think that Mr. Jacobs would know that. They were agendized as individual items. And the reason I say that is because we're at the tail end. I think we're all tired. I know that everyone at this table has really been paying very close attention to all the presentations. And one of the things that I wanted to bring up that I was concerned about as I looked at what we were going forward with in the presentation was Professor Lerner's presentation in particular. And it's not really fair to us or fair to him. I can't really question him, and he can't really defend himself when I raise some questions about his background and qualifications, because Mr. Eliopoulos, does present the fact that he teaches at Harvard Business School, but I know that also Professor Lerner is, and this all came up on a simple Google search. He's a advisor since 2009 for Grove Street Advisors, which is a major private equity firm. He's listed also as an advisor at Caspian Private Equity as the strategic advisor. And I'm concerned that he may have, a certain amount of conflict of interest. That is that I can't ask him, but that most of his income is coming from, in fact, the private equity industry. And I even look at his research institute and the tax filings for that research institute. His directors are essentially from the private equity industry, and his funding comes from the private equity industry. And so, I'm concerned that the presentation, obviously all the other presenters are investors in private equity, and Professor Lerner is being sort of presented as an independent, but really he isn't. And in fact, he's the most conflicted presenter today, in that he is one of those people who holds himself out as an advisor to these funds of funds, as someone who can pick the winners. Because as we see on that curve, many of these funds just aren't winners. And I worry, as somebody who's been a member for 30 years, that starting in 2007, we saw this huge spike in this type of investment. And I want to acknowledge that that's long before Ms. Dosbold became the CEO of CalPERS, and it wasn't on her watch that this happened. And I have a feeling that we're trying to reel this back. But I just want to encourage our ex officio constitutional elected officers who are on the board here to continue, as they have been, to ask these questions, to call for legislation, to call out with the SEC some of the bad practices that are going on, because we can't just focus on returns. I mean, someone could go out and pay a homeless person to rob a bank. We'd get a great return. But that's not what CalPERS wants us to do. We want to be involved with investments that are socially responsible, that are lawful. That is, these carried interest issues where really they may be completely unlawful, where we're getting gamed on fees, where the returns that we're really entitled to, we're not getting. So like I said, I'd like to applaud especially Treasurer Chang and Controller Yi for asking those questions and continuing to ask those questions. But I was really sorry to see that our presentation was a little less open today than I saw in the past years ago when I used to come to CalPERS meetings. So thank you.
Okay, thank you. The next request to speak is Ms. Morris.
Hi, my name is Pamela Morris. I'm a business student. I had a couple questions for the board that I was hoping you could clarify based on the presentation earlier. In particular, slide 40, I don't know if we can pull that up at all. It was in Dr. Lerner's presentation. So I'm curious, based on that slide, if the return environment for private equity is in relative and absolute terms as favorable as it, or similar to or different from what it was in the 1990s. I think what we see on slide 40, it seems to suggest that you have perhaps a problem of too much or more money chasing fewer deals compared to in the past. I'm curious if anyone can address that.
No, our policy is to hear your comments. We're
Sure.
not going to have a dialogue back and forth.
Okay. Well, then I guess my comment is it seems like there's more money chasing fewer deals than in the past compared to prior years, which could be of a concern. My other comment is around, it's perhaps directed towards the consultant from Wilshire. I know you can't answer, but I'm left wondering how you advise your clients, given that about half of them, or in order to make significant returns in private equity, they have to beat the average. So if you're advising all of these folks on private equity, I'm not sure how you would advise them all that they're all going to beat the average. I think what we saw in Dr. Lerner's presentation was that on slide 32, if we can look at that as well, that you really do need to beat the average in order to claim superior returns in private equity. And I think to Mr. Jelnicik's point earlier, since we have perhaps less disclosure of funds that are underperforming, even perhaps this curve right here, overestimates the returns that we're getting in private equity. So I'm also left wondering how we can, how you can be advising everybody that they're going to beat the average, and how CalPERS can really think that they'll continue to beat the average in private equity. My last point, the point was made earlier that CalPERS has invested such large amounts that it can't really manage the sub-portfolios, I think, and access some of the higher performing funds. I think the example was given of venture capital and not being able to access some of those great Silicon Valley returns. So I'm curious also if you can't get some of the best returns, again, to Mr. Lerner's point about needing to beat the average, it doesn't seem to make sense to me how CalPERS can think that they'll continue to beat the average in private equity if they can't manage the sub-portfolios. Thank you.
Next, we have Rosemary Butt. I think that's correct. Hi.
Thank you very much. My name is Rosemary Bott. I'm a professor at Cornell University, and I'm on sabbatic at Berkeley, which is why I could come today. My comments are based on a book, which I have right here, which I just wrote on private equity, along with economist Eileen Applebaum. And in that book, we summarize all of the econometric evidence on private equity's performance, several of the papers that Professor Lerner cited today. And so I want to talk a little bit more about the performance data and just expand on Professor Lerner's excellent presentation. The findings from that core Harris article that he mentioned are very important. He reported a 27% outperformance for private equity vintage funds in 2000s, which equals an annual excess return of about 2.4% if you assume a 10-year lifespan. To clarify, this finding is based almost entirely on estimates if you look at the paper, and so it's not based on actual returns. The paper also reports returns on funds over 3 decades, and there the average annual excess drops to 2%, and the median is about 1.2%. So that's in the Harris paper. When the private equity funds are compared to the Russell 3000 and 2000, which cover the mid-sized companies that are more comparable to private equity-owned companies, private equity performance is worse, beating these indexes by between about 1% and 1.5%. So moreover, the pension funds, if they generally require a premium of about 3% over the stock index, in order to adjust for greater risk or illiquidity, none of the estimates in this important paper, probably the most important paper recently, would warrant investment in private equity. Two more points. Professor Lerner then refers to another really important paper by Robinson and Sensoy, they actually report a performance based on real returns, so liquidated funds. And here they find that the average fund does outperform the stock market by 1 to 1.5%, depending upon the index. The median fund, however, just matches the stock market, which means that 50% of the funds do not perform as well as the stock market. It is the top quartile funds that outperform both indexes by 3 or 4%. So if we put this together then, Professor Lerner also points out this problem of persistence of performance. And the studies he refers to show that prior to 2000, the private equity firm with the top performing fund had about that 50% chance of being in the top performing funds in the follow-on fund. But since 2000, that probability has dropped to 22%. And that is less than would be expected if the distribution were random. And so in sum, I worry, based on our review in which we've turned the kind of technical papers into lay language, and that's what we try to do in this book, you look across the studies and they really do not provide the kind of evidence to suggest that private equity beats the market in general, and especially if you take a risk-adjusted return into account. While the top quartile do beat the market, then the question is this persistence problem. It is no longer possible to use a private equity firm's track record to predict funds that have the best chance of beating the top performers. And there's a longer discussion, but it really does not have to do. Yes, great staff really, really help, but they only have a certain amount of control. And if you think about, for example, Texas Utilities, KKR's investment of a $48 billion deal, that went down the tubes simply because they had an 80% debt, and they could not foresee what was going to happen in the energy market. And that's not within the control of the staff. So thank you so much and I'm glad to provide an electronic copy of the material.
Thank you. The next request, Michael Flarman.
Thank you. I'm Michael Flarman. I'm a visiting scholar at UC Berkeley in the Goldman School of Public Policy, where I study private equity. Before that, I worked for a private equity firm for quite some time in senior roles. It's a private equity firm to which CalPERS has allocated meaningful amounts of money. And before that, I was on the CalPERS board. I was Priya Mathur's predecessor. And this is the first time that I've addressed the board, actually, since I left in January 2003. And what I want to say is that what I was struck by in terms of what I had kind of hoped for this presentation to be about that was really missing was that there's an enormous opportunity right now in private equity. And I felt like there was a lot of emphasis on sort of what you can't do and what you can't achieve and what the constraints are. But there really wasn't much opportunity, much discussion of the opportunity. And the thing that I would like to put on the table is I was on the board in 1996 when what was alluded to today as the Mercer report was commissioned by CalPERS. And this was a report that basically laid out in very strong and plain language what was wrong with private equity in terms of terms and conditions at that moment, right? It was a different moment than this moment. And absolutely, as many people said, it was a worse moment. It was a much worse moment. But what it did was by putting the gauntlet down, it really shifted the market. Every meeting, every general partner I met for 3 years after that report came out brought up that report, right? They hated it, they resented it, but it moved them. And I think you could do the same today. And what I would actually focus on if I were you is I would focus on portfolio company fees. Because portfolio company fees are basically indefensible. There's really no reason why a dollar should come out of a portfolio company in a non-transparent way. Because one thing that wasn't discussed today is that portfolio company fees are never paid to the fund. They're paid to the general manager around the fund. And that's why you can't audit them. That's the whole problem of portfolio company fees. That's what the last 3 SEC settlements have been about, is Blackstone, KKR, and Fenway were all defrauding their investors about portfolio company fees. The industry is on the run regarding these fees right now because they've been caught with their hand in the cookie jar. You could beat them if you take them on and if you're smart about it. I really believe that that's the case. And there's another problem with portfolio company fees as well, which is they are, in many cases, a tax scam. And the state of California is being defrauded by this tax scam. And the tax scam is very simple, which is that when the private equity firm pays out, when the portfolio company pays out a portfolio company fee to a private equity firm, it's pretty apparent when you look at it that they're paying it out because the owner says, hey, give me $1, right? And when you say as an owner, give me $1 to a company you own, there's a name for that. That's called a dividend, right? A dividend is not tax deductible to a business, but a fee for service is tax deductible for a business. And so guess what? These are all labeled as fees for services. But when you look at the contracts for these fees for services, the contracts actually literally say no services need to be required in order for you to be obligated to make these payments. So that's a very significant tax fraud. And I'd be very interested to go over to the Franchise Tax Board and make a presentation in public comment about how the Franchise Tax Board actually really should be paying attention to this. So that's an example of how I think really being smart about how to beat them really could pay dividends. I also just would like to make one comment about the fee waiver presentation. I was disappointed. The IRS is cracking down on this. There's a proposed regulation that to put this out of business because the IRS recognizes it's a scam. And the comment period, in fact, closes today. And you guys kind of walked into it, I think, without really recognizing it. Because if you say that the cash flows don't change, you've endorsed the idea that it's a scam, right? Because the GP's whole story about it was that the cash flow was that there was real risk, that there was a real possibility that the cash flows would change by virtue of waiving the money. So what didn't really get explained about the fee waiver is an element of compensation for the general partner, but you're not counting it. And I think that's another thing you guys need to grapple with, actually, is that there are 4 elements of GP compensation: management fees, carried interest, portfolio company fees, and fee waiver. And you guys are tackling the 3, but fee waiver is still sort of somewhere out there, so I hope you'll get on that as well. Thank you.
You're welcome. Susan Webb.
My name is Susan Weber, and I publish the website Naked Capitalism. Members of the board, staff, and experts, since my time is limited, let me get to the point. The overarching message of this workshop has been that private equity delivers returns that are superior and are therefore necessary for CalPERS' investment program. In other words, there is no alternative. As a result, CalPERS must submit to various indignities, such as lack of transparency, extremely high fees, one-sided agreements, and outright corruption. This message is false. There was a considerable amount of sleight of hand at work in those slides, most important in the analysis of returns, and Professor Bott touched on that a bit. Due to time limits, I can give only a few examples. First, in the opening section, you implicitly had a new benchmark introduced. The returns were compared against the other asset classes in CalPERS' portfolio. That's not how private equity has been presented to the board in the past, nor is it what you will see in the next section when Réal Desrochers presents the annual program review. If you look in the next section at page 20 and 21 of his slides, you will see that private equity has not met its benchmarks over the last 10 years or in any sub-period. Worse, PE not only failed to meet its risk premium, it's often failed to beat similar stocks. In other words, CalPERS is not being paid enough for the risks it is taking in private equity, and by a lot. Second is that everyone who presents private equity returns, this is across the industry, this is not specific to CalPERS, fails to include the cost of accommodating capital calls. When a limited partner signs a private equity agreement, it doesn't send the money. It's a commitment, which is much more. It makes a commitment, which is much more like a line of credit. The GP makes a capital call for a specific amount of money, and CalPERS must wire it, typically in 5 to 10 days. The implication of that is that CalPERS must keep the money somewhere to accommodate the capital calls. That means it's going to be in more liquid, lower return investments. Lower returns in the beginning of an investment period have a disproportionate impact on total returns. Now, using typical drawdown periods and generously assuming that CalPERS puts a high percentage of this money in high return liquid investments, like your stock index, lowers the return of private equity on a typical fund over the life by 1 to 3%. Third is your volatility assumption. This is critical to the pretense that there is no alternative to private equity. One of the things that Professor Lerner mentioned is sort of a foundational belief in financial management, that high risk return, that there's a risk return trade-off, that higher risk involves, to get higher returns you need to take on higher risk. Yet the chart on page 11 showed that CalPERS that PE gave a free lunch of basically high returns and comparatively low risk. However, if you look at that slide, there's been a substitution made. At the beginning of the presentation, it used expected volatility. It switched in that slide to observed volatility. Unfortunately, observed volatility is fictitious volatility. Public markets prices are based on real trades. PE valuations aren't. For example, there would have been no bid for most private equity portfolio companies or the funds themselves at the height of the crisis at September 30, 2008. Yet the reports don't show that. It's invalid to use data compiled by two different methods to calculate standard deviations or correlations. But the slideshow takes the dubious data and plugs it into an optimization model to produce the free lunch result on page 12 and to knock the alternatives to private equity on page 15. And if you think that conclusion's unreasonable, your own consultants, Wilshire and PCA, use higher volatility assumptions, as do top players like Goldman, JP Morgan, and Yale. And those volatility assumptions are based on studies that used actual cash flows from private equity, not the GP valuations. Another point I wanted to address briefly was the confidence that this group places in ILPA. The fact is that ILPA disavows playing any advocacy role on behalf of limited partners. Kathy Hermanis-Larson, who is the executive director until mid-2015, said in an interview she didn't agree with using the term advocacy with respect to any of ILPA's activities, and went on to state, "We don't speak for our LPs at all. In fact, our members are quite sophisticated. They have their own negotiations and their own discussions with GPs. So I think we are just a facilitator to bring folks together." The reality
your
is
time is up, Mrs. Weber. I allowed you 5 minutes.
Okay.
Your time is up. Thank you very much.
Thank you very much.
Okay, this concludes our workshop, and I want to thank my. Oh,
I'm sorry. I just wanted to clarify one point.
okay, sure.
That under government code, there were a couple of comments on the Bagley-Keene Act. I just wanted to clarify that under the government code, section 11125.7A, the entire private equity workshop is a single agenda item. So that's why it's appropriate to have public comment at the end of the workshop.
Okay, thank you very much. Excuse me. I'm going to ask you to be removed if you don't be quiet. Okay, Rob?
Yeah, thank you, Mr. Chair. I just want to, on behalf of the chair as well, join you, Henry, in thanking the staff and all the panelists for a great presentation today. A lot of really tough work. You all have been working on it for a long time now, but I want to just be on behalf of the committee and the board. Thank you for all the work on behalf of both the panelists, the speakers, and the staff. Great job. Thank you.
Okay, good. And thank you for those comments. And so I want to also just echo those words to Ted and staff. You guys did a wonderful job, and I thought that the workshop was very enlightening and productive. So with that, a job well done. We will reconvene the investment committee in 10 minutes. That will be, let's call it 3:30. 12 minutes. We don't have a recorder. He's not in here. So if he was here. No, in the auditorium. Okay.